Good morning, everyone. Welcome to this update for global stocks and commodities for the 6th of August. It was another fairly quiet week. Not a lot happened on global markets, and despite the nervousness, the markets are holding up pretty well. There is, as I've been referring to over previous weeks, there is a sector rotation occurring, which is just a natural part of how markets operate. So I just want to take a look at what particular stocks and sectors are experiencing that money flow. So let's jump in and have a look at what we're going to review this time. There is a new service coming, so I just want to make reference to that. There are really no signs of global equities topping, despite the fact that more and more people are getting more and more negative, and money is definitely flowing out of the mutual funds industry in the States and going into bonds. So I want to give you a factual view of where we stand and not an emotional view, which I think is what most people are peddling at the moment. We'll have a look at what sectors are doing best. And I also want to take a look at Australia. Now, as you know, I've been pretty cautious and even a little bit negative on the Australian market now for some time. And I really hate doing that, but I have to call it the way it is. It's just been very, very hard work to make money in Australia for quite some time, and our market has badly lagged. So I want to have a look at why I think our indices are at risk, given some of the big international factors that there's really nothing much that we can do about. And also what is attractive in the Australian market. I don't think you should desert the Australian market, but you need to be very, very specific about what you go into, and you need to be very careful about how you actually do it. So I want to take a look at that as well. So just on the new additional service coming, I just want to make I'll provide more detail in coming weeks. But as you know, I finish each weekly video with an invitation for non-members to communicate with me if there is a question that they would like answered, and any assistance that I might be able to provide to them. And I know that has been of assistance to some people, because I obviously get the feedback. But several things have become evident to me over the last 6 months or so. The first one is that there are some questions that are put to me that I just can't answer, and that's due to a couple of reasons. One is the regulations about what information I can provide to members and what information I can provide to non-members, and my hands are tied on those sorts of things. And secondly, of course, just fairness to paying members. I can't provide the same sort of specific information that members pay for to members who don't. So there are certainly some questions that I can't address. Also, it's clear to me that some people would like services more particularly tailored to their specific needs. And so I'm going to be attempting to do that. And thirdly, there's the issue of timeliness of market analysis. Markets have been fairly quiet for a while, but a lot of the time they move very quickly. And coming out with something once a week on a Sunday may not necessarily be timely enough under some circumstances. So I'm addressing that issue as well. So to cater for all this, I'm going to be launching a new suite of services that I think will appeal to a lot of current non-members. So more in that in coming weeks. So let's move on. We'll look at American stocks. There is no end in sight to the rally, and from a fundamental point of view, there's no reason for the rally to finish either. And I say that for these reasons. Sentiment remains generally cautious, and it's getting worse. Or perhaps I shouldn't say worse, because that has a bit of a negative attached to it, but sentiment is certainly not improving. It's going the other way. Secondly, funds are generally underweight US stocks. They just don't have the weighting to US stocks that you would normally have. Thirdly, the global economy is improving. That's just obvious wherever you look in the US, Europe, China, even Japan. And fourthly, earnings season really supports the current valuations. So for all these reasons, it's virtually impossible for us to be forming any sort of meaningful long-term top. They just don't happen that way. It's just not going to happen at this point in time. A lot of things have got to change, and that takes a period of time. Now, could we get a short, sharp correction? Of course, absolutely. And we've had those since 2011. We've had several of them. We had quite a nasty one at the start of 2016. But did that interrupt the uptrend? No, it didn't. And so I think it's going to take quite some time for markets to actually top out into a more meaningful bear market. Now, the S&P index was higher for the week. Breadth remains at high levels. That's another reason that you don't get market tops at this point in time. So many small cap and mid cap stocks are doing really well, setting new 52-week highs. This is not a sign of a top. And right at the moment, we're continuing to see this sector rotation. Technology had a bit of a wobble. It's recovered. But some parts of technology are coming off the boil again. It's quite industry group specific, so it's certainly not across the board, and some technology stocks are still doing very well. But it's clear that there is money rotating into the finance sector, and also in the last week, utilities have been looking stronger as well, and also some industrials. But again, industrials is a real mixed bag. Some sections of industrials are not doing very well, some are, and then if you drill down further within those industry groups, you're seeing a lot of very stock-specific behaviour. So it's very hard to generalise about the market at the moment. But if you put all that in the mixing bowl, then what you end up with is an overall index, the S&P, the NASDAQ, the Dow, the Russell, that really are showing very little movement. But underneath the hood, there's quite a bit of movement on a stock-specific basis. So let's take a look at some charts. So we'll start with the S&P, and you can see there's the last 5 days. Very little change, just up by 5 points. And what you can see, however, is that the blue 50-day moving average line is still moving up nicely. The green 20-day moving average line is still above it. No sign of weakness. And of course, the price is above both of them. So this is an uptrend, and that uptrend is showing absolutely no signs of weakening. We got a little bit of movement here in July back to the 50-day moving average. We've got a little bit of movement slightly below it in March, April, I beg your pardon. But that was, really it's more sideways than anything else. Bit of a slight decline, but it's still ongoing strength in the US market. The NASDAQ, no real signs of weakness there. You can see that we had quite a decent trend upwards that then started to further accelerate in July of last year, and this is a weekly chart, by the way, so that has just continued to accelerate to the upside. And just no signs there at all. The previous trend channel, the price has broken out of that trend channel and is now forming a channel at an even faster pace. So nothing to be concerned about there in the NASDAQ, but of course underneath that there is some variation. And the Russell, this is the chart that I looked at last week. So I posed the question, what would signal a breakdown of this pattern? Well, if we got a move below this support line, which occurred on Thursday, but then it promptly reversed itself on Friday. So you've got to allow for little overruns of support and resistance lines, so I'm not perturbed by that at all. The short-term uptrend, the accelerating uptrend has been broken. So I read that as we have now increased the odds of more sideways. So we may be getting more sideways within this overall pattern. But to me, on a bigger picture view, the Russell has broken out. And I think over time, and I'm talking at least 6 months and to 12 months and longer, it would appear to me that the Russell is poised to head higher. So that's the message there. Let's look at the US dollar index, because this one obviously was vitally important. We had key support down here at around 92.5. We got down to that on Wednesday and Thursday, and then we got the inevitable bounce that occurs from such major support levels. They almost become self-fulfilling prophecies as traders position themselves for a reversal in trend. Now, of course, the big question is, will this continue through to the upside, or is this just a bit of a dead cat bounce? I think a good part of the reason why the US dollar is down over the last few months is, clearly people are now getting concerned that Trump's going to be able to get anything done at all, and so that's contributed to a weakening of the US dollar. There's also been strength in the euro that hasn't helped. So there's been a number of factors all coming together. It raises the question whether the US government, after many, many decades of having a stronger dollar policy, whether Trump, in his efforts to try and make America great again, is actually going to try and engineer a weaker dollar. That's just conjecture at this stage, but it's all feeding into weakness in the dollar. So the question is, will this bounce in a sustainable way, and how far will it go? It's impossible to know at this stage. It's just basically a day-by-day situation. But I can tell you that if this support level at 92.5 breaks, then we could well be in for a sharp move down to below 90. And whilst that seems illogical given where interest rates are, it's of course possible. So that's what's to look out for there. Just while I'm here, let's look at the impact on the Australian dollar. So the Australian dollar has broken above this trading range, kind of defying all of the fundamentals and defying all of the wishes of the RBA in particular, but also just about every respected economist in Australia that's been calling our dollar at 70 and below. And I still think that that's on the cards. Currencies have a habit of doing strange things over shorter to medium term points of view, going in a direction which seems completely illogical. To me, all of the big drivers are still in place, and all of the things that are likely to contribute to a weaker Australian dollar are certainly still in place. So Aussie stocks, we finished at 79.3. Our index was higher by 17. And I just want to take a look at why we've lagged. Well, first of all, let's have a look at what we've done since the GFC compared to other markets, and you've seen what the other markets have done. So why have we lagged so badly since the GFC? And in my view, it's hard to see anything much changing amongst the large caps. If you think about the stocks in the top 20 in Australia, they're banks, they're the major miners, they're telecommunications companies like Telstra, and a few large industrials. And it's really hard to see anything much changing amongst those large caps for them to start to trend in an upward direction. So for me, if you are going to be in the Australian market, it needs to be around small cap to mid cap stocks that have a niche position, that are particularly going to benefit from disruptive kind of technologies, and that are global facing, so they're not relying on the Australian demand for their business. So before I go back and look at the charts, let's just have a bit of a look at the Aussie market, both from an index outlook point of view and also from an economic point of view. We lack the technology stocks here that are the big drivers of change and disruption. If you look at the Googles and the Facebooks and the Amazons and all those stocks, we just don't have them in Australia, and that's where the disruption and the change is coming, and the entry of companies like Amazon into the Australian market are going to have a very significant impact. Our market is tends to be dominated by industries that are affected by that disruption. So not only do we not have the positives, the positive changes, but we are on the receiving end of those disruptive changes. So the economic drags for Australia, we've got massive household debt, and of course that has to have a long-term impact on consumption. It just can't be any other way. We've got an energy crisis on the east coast of Australia, and if we had competent government at either state or federal level, we'd probably be able to get ourselves out of it, because we've certainly got the resources, but we just don't seem to have the political will to be able to develop them. And that energy cost is a huge impost to productivity in Australia, and it's a huge competitive disadvantage on a global scale. So we've got inept government all over the place that's basically stifling productivity, and I don't think the impact of that can be overstated. We do have some positives. I think tourism has certainly picked up, and that has the potential to provide a significant boost to the Australian economy, but it's not going to happen with the currency at its current level or higher. So our currency definitely needs to come down for that to kick in. So let's take a look at the Australian market. So we'll start first of all with the ASX 200. So let's take a good slice of action here. So let's go back to 2002, right over on the left-hand side. So here's the peak in 2007 in October, and that was just shy of 7,000 points. Now you can see that unlike the US market, the DAX, the German market, we are just so far below that 2007 peak. A decade later, it's not funny. And we are still below the peak that was formed in 2015. So 2.5 years ago, we're still not trading above that level. So that's the big picture there. But let's look at the banks, dig down and have a look at why. So everyone thinks that the banks have been the place to be, and really it's only because they provide an attractive fully franked dividend yield. I think if we didn't have that in this country, the banks would be in a lot of trouble. So if we go back to 2007, you can see that the banks were trading here, the banking or the finance index, which is essentially our banks, was trading at 7,500 points. We're now currently at 6,500 points. So more than a decade has passed, or almost a decade has passed for the Australian finance sector, and we've made no ground at all. And that is just in such stark contrast to the rest of the world. So buy and hold investors in the banks have basically made their fully franked dividend, and they've lost a bit of money on the capital side. If we turn to the miners, let's have a look at what the miners have done. And the miners in that same period, as you can see, we've done very well out of the miners since 2016. So the miners have actually moved up from around 6,500 points to 10,000 points in the last 18 months. And that's helped hold the ASX 200 up. But if you look at where we were in 2008, we're still a long, long way short. So that's where we're at. We're clearly lagging. There are very, very obvious reasons why we're lagging, and none of those factors I can see are showing any prospect of changing anytime soon. So that's why I just cannot see how the Australian index is going to do anything different to what it's done for the last decade, and may well get worse. So unfortunately, that's a bit of a somber outlook on the Australian market. Turning now to precious metals, gold fell by $11. The big picture remains relatively positive, and I'll go back to that in just a moment. The holdings in the ETFs continue to erode as people are giving up. Some of the longer term holders are throwing in the towel, and from a contrarian point of view, that's a good thing. Precious metal stocks, The shorter term has become really quite stock specific. Just in the last week, I've seen an enormous amount of variability. Some stocks have moved up with the overall sector, but some have been hit very hard, which has generally been about poor results, and they've been really punished very badly. So let's take a look at gold. First of all, on a daily chart, had moved up to the 1270 mark and lost a bit on Friday as the US dollar turned around. So that's just currency impact. But if you look at what the dollar or what gold has done in December of 2016, so basically this year, gold has moved from 1130 to 1260, and we've formed higher highs and higher lows pretty much all the way through. Now we've got a bit of a consolidation range here at the moment, but that's generally a positive pattern coming out of a very, very substantial bear market. So it may not be moving ahead in the way that a lot of people want, but you've still got to look at that and say, well, from the absolute lows in the end of 2015, gold is now higher, and there's been some meteoric action in that time span. Let's look at GDX. This was the weekly chart that I put up last week, and I really posed the question, what do we need to see to get more positive about gold stocks? And none of those things have become evident yet. We've not seen a move up. We've not seen rising volume. We've not seen candle ranges expanding. That was the week last week. And we've certainly not seen a breakout. So we're none the wiser on precious metal stocks at this point in time. Turning now to other commodities, copper held its gains at 287, and crude oil also steady, just a tick under $50. There is a bit of a base forming, I believe, in crude oil and in energy stocks, but that base could continue on for some time. Sometimes bases can take a year or 2 years to form. So there's really no sign of a breakout yet. I think the worst is over for the sector. But I really don't see any reason to be wanting to move your capital into the sector. So let's just look at a couple of specifics here. This is XLE, which is the overall energy sector index in America. It's pulling back. We had a low here, the absolute low in January of last year, so 18 months ago. This was down around 50. We've now moved up to 65. So we've had an initial run, we've had a pullback, we're now back, and I believe probably forming a trading range until the market shows us differently. Now, just zeroing in on one sector in particular, I think if a sector to keep an eye on will be the oil services sector. This is an ETF, OIH. And this is where I think the uptick is likely to be seen first. Most times that's where it occurs, because it's the drilling, it's the early stage services that move first, and so that's one to keep an eye on. The ideal way to play the sector: wait for the volume, try and buy the bottom of ranges or towards the bottom of the ranges, build sequentially. You know, they're all the ways to go about building your exposure, minimizing the risk and maximizing your upside. There's the spot copper chart, and there's the crude oil chart for 3 months, both showing that not a lot happened last week. So to wrap it up, this is a seasonal time to be vigilant. A lot of people try to avoid the small 5% and 6% corrections. In my experience, it's a waste of time. It's incredibly difficult to do, and it's almost impossible to do on a reliable basis. And it's almost certainly going to cost you more than what you could possibly gain by it. So, you know, if you're a longer-term investor, you just need to look for the signs that we're getting a more major change. And as I've covered in these videos, there's absolutely no sign of it. So wait for the dips, demand an edge, let the market come to you. You don't have to have your money in the market. Money sitting in cash, which is allocated for a purpose, an opportunity, is an asset. It's not a liability. So, don't let that cash burn a hole in your pocket. Use the inevitable fluctuations in the market to advantage. One of the market realities is that money flows from one sector to another. Sectors don't stay in favor all the time. So use those money flows, use those periods of weakness to advantage. And of course, stay with the strength. The strongest sectors are just that for a very good reason. And they're likely to continue that way until the market shows us something different. There's my contact details for non-members. Always happy to communicate, and I'll be back with you next week. Cheers.